Don't buy stocks in 2026 until you understand this, because the market you're stepping into is completely different from what most investors are used to. For years, people made money easily by following trends, buying popular tech stocks, and riding the wave of cheap money. But that era has changed. Today, interest rates are higher, money is more selective, and the rules of investing have shifted. If you jump into the market without understanding this new environment, you're not investing, you're gambling. And in 2026, that mistake can cost you heavily. The first thing you need to understand is how the market itself has evolved. In the past, companies could grow rapidly without worrying too much about profits because money was cheap and investors were willing to wait. But now, that patience is gone. Investors are focusing on real earnings, strong cash flow, and sustainable business models. This means the hype-driven stocks that once dominated headlines are no longer guaranteed winners. In 2026, disciplined investing beats emotional decision-making every single time. Another major shift is how smart money is moving. Big institutional investors are no longer chasing the same overcrowded trades. Instead, they're quietly rotating into sectors with strong fundamentals, areas like energy, industrial growth, and the infrastructure behind artificial intelligence. While retail investors often chase what's trending online, professionals are positioning themselves ahead of the curve. If you're buying stocks just because they're popular, you're likely entering too late when the biggest gains have already been made. One of the biggest mistakes new investors make is buying stocks without a clear plan. Before you invest a single dollar, you should know exactly why you're buying that stock, how long you plan to hold it, and what conditions would make you sell. Without this clarity, you end up reacting emotionally to market movements instead of following a strategy. Successful investors don't guess. They plan, execute, and stay consistent. Valuation is another critical factor you cannot ignore in 2026. A company might be great, but if you overpay for it, your returns will suffer. That's why understanding basic metrics like price-to-earnings ratios, revenue growth, and profitability is essential. The goal is not just to find good companies, but to find them at the right price. This is where real investing separates itself from speculation. At the same time, diversification has become more important than ever. Markets today are unpredictable, and concentrating all your money in one or two stocks is a high-risk move. Smart investors spread their capital across different sectors and industries to reduce risk and create more stable returns. In this environment, protecting your capital is just as important as growing it. When it comes to timing, many people try to predict the perfect moment to enter the market, but that's nearly impossible. Instead, a smarter approach is to invest gradually over time. This strategy, often called dollar-cost averaging, helps reduce the impact of volatility and prevents you from putting all your money in at the wrong time. In 2026, patience is not just a virtue, it's a powerful investment strategy. Another key advantage investors have today is access to information, from earnings reports to economic data. There's no shortage of insights available. But the real edge comes from knowing how to use that information effectively. The more informed your decisions are, the less you rely on luck. In a complex market like this, knowledge truly gives you an advantage.